Okay, so earlier in my last video, I talked about the De Beers, or I talked about the Rothschilds, and I talked about them owning companies like the De Beers and them their personal net worth being worth 10 trillion to 20 trillion dollars. But once you add all of their net worths of throughout the companies that they own, it's probably closer to about 500 trillion or more easy, or at least 5 times the amount if they're taking 20% of their company value out, or not company value, but taking 20% as personal income, and it being distributed through the family office. So I said all that to say, to come back to this point, close, talking about sovereign money. Scrolling down, the part that I care about right now is this public. I probably should turn my camera on my phone. Okay, so public equity, fixed income, real estate, private equity, private credit, hedge funds, infrastructure, cash, natural resources, and other. Okay, so natural resources would look like oil syndications, etc., gold, cash. You can have cash. Yeah. Other would also look like bonds. Infrastructure would be, if you buy into the infrastructure, let's just say you own the utility companies of the world. It's safe in money, it's safe income. You know that it's going to come back because everybody's got to pay their electricity bill just to keep the electricity on so they can stay warm and stay out of the elements of cold weather to eat and have food, etc. So that's what it means by infrastructure, health, hedge funds, and then you have private credit. Private credit deals with a company that's not going public. They don't really want to go public, but they're still a company. Most times ventures and different things of that nature are that way, but I think with the new transparent law that just took place, a lot of companies are going to steer towards being private, because going listed on the stock exchange, there's too much red tape that they don't want to, or they're wanting to avoid. So private equity and private credit, you can expect to kind of go up. Private credit simply means that dividend paying, or dividend paying, or a kind of like guarantor. Think of guarantors. Think of I got a pee-pee. I'm sorry. Let me pause. Whew. Okay, and so I finally came back from the restroom. I really had to go. So I'm actually going to type in on my phone. Private credit. Plus I can draw on here. As you can see, the very first thing that pops up is an investment opportunity in Blackstone, which is more than likely affiliated with BlackRock. Let's be for real. Let's be so for real, as my sister says all the time. I'm sitting there like, will you hush? It's literally the most annoying comment that she makes, but whatever. I love her to pieces. Anyways. So what I'm going to do is type in what is private or Investia, because they'll tell me what it is. Okay. Invest in private credit, 13 to 20% APY. See that? Okay. Private credit versus private equity. And we're going to read what it says. Private credit versus private equity. What is the difference? Private credit versus private equity. An overview. Securities traded on the public market, like stocks and bonds, may be the backbone of most everyday investor portfolios, but there are also plenty of alternative investments that aren't publicly available, like private credit and private equity. These assets can be quite profitable, but because they are also risky and tend to tie up capital for a long time, trading, they're only risky if you don't know what you're doing. Trading generally takes place among institutional investors and accredited investors. So let me ask you a question. Why would an institutional investor participate in risky trading? They want to make money. They're not in it to lose money. Okay? Whenever they do anything, they're going to have an agreement. And it's going to be written out. And if anything crazy comes out of it, there's going to be a lawsuit. Because there's going to be money that gets given back. Okay? It just is the truth anyhow. And we're going to look at what the definition of an institutional investor is and what an accredited investor is, okay? And the qualifications for it. So, in the private credit market, investors make loans. Okay, so what does it say? Private credit market, investors make loans to businesses, sometimes individuals. So private credit is whenever you make a loan to a business or an individual. Trouble accessing credit and banks to public market, because there is often a heightened risk that borrowers may be unable to repay the loan. Private creditor investors can collect higher interest rates than they would earn on bonds or other debt investments. Okay, so private equity investing involves taking an ownership in a company that isn't currently publicly traded. Unlike a stock, which can be easily bought and sold on a public market, private equity investments require investors to make a longer-term commitment with their capital, so allowing it to grow. Pretty much, you're saying, "I'll give you." It is still technically a loan. You're pretty much saying, "I'll give you, but I own a portion of the company you're trading over ownership." I'll give you. Oh, I should have a pimple in my ear that hurts. Such and such amount. For equity in the company. Because I believe that you're going to make $1 billion. Okay. So when they make $1 billion, because you own equity in the company, let's just say they made $6 million to date, and you're banking on them making, that's 10x. You think they'll make at least $1 billion, so, or be worth $1 billion. That's 100x. 100x at 650, so about 650. And that's 150x. So for every, at minimum, 75, I'm trying to get as close to it without going over 65, 70, so 166x to make 1 billion. Okay, so then, or closest to 1 billion actually is less than, more than that. So, underball it and you'll see it inside the video. So, if I invest $100 and I time to buy 166, I've made $16,000 just by investing $100. Now, if I put $1,000 in and it still goes up $166, that instead of making $16,000, I made $1,600. So, I'm pretty much saying that the company is going to make such and such amount of money. So it going up 166x, and me just putting in $1,000 means that I'm going to make $100,000 regardless. And that's the way you look at that. Now you can look at it based off of a number amount, or you can look at it based off of this. Let's just say this is pretty much stating, because you're using the power of 1, so you're saying that each share is worth $1 because you spent $1,000. Now let's just say that we're going to do it based off of shares now instead of just money. Okay, so let's just say each share is worth 1 penny. 1 penny is not a lot. Now I put $1,000 in, which would be 100,000 shares that I would own. Okay, so I'd own 100,000 shares because it's worth 1 penny by putting in $1,000. So they made $100 billion. Let's just say their stock price, their share price went up, because I said it would be, the share price more than likely is going to be more than $1. Okay. $1 would mean $100,000. $10 per share is $1 million. Because I have 100,000 shares, and the share price was only a penny. Now let's just say the share price is 10 cents. 10 cents. And I still spend $1,000. I get 10,000 shares at 10 cents. Times that number by, what was it? 166? 166, I made $1.6 million. So, but if each share was $1, priced at $1, because remember, a number times itself, or a number times 1. What is that saying? Because I said this would be the share, or the amount of money. So I'm saying that 1 share is equal to $1 in this scenario, because any number times 1 is equal to itself. So that just means $1 for the share equals $1 spent for equity. But if the equity is worth less at the time of purchase, and it's worth 10 cents instead of $1, and when it reaches $10, because $10 is an easy number, you still walk out making a whole bunch of money. You made more money than you did originally by spending that same $1,000. So when you look at purchasing, and this is in private equity, this is in crypto, digital assets really is what I prefer to call them because that's what the United States calls them in the United States Code. And that's what you look for. So, crypto or digital assets right now, because of just the how small the liquidity pools are, most cryptos are seen they see it as gambling. However, there's private credit opportunities within crypto, which means that you loan money out and you loan money and they give you money. And because there's so many different opportunities like that exist, I would want a part of that too. I would want to own a part of own private equity. And the reason why I wouldn't want to own private credit, inside the crypto space, is because I know that I'm going to get paid consistently every month. I'm going to get paid, or every week, or whatever that looks like. So let's just say it's $1 that I invest, and they give me 25%. That means they're going to give me 25 cents every single time, right? So let's look at this, and I know that's not a lot, but I'm just using $1 as an example. If they're giving me 25 cents in US dollars, right? But the crypto itself, for instance, gbex is gbex. They expect to manage 5 different countries. That's a lot of countries. They have patents. They are the Comtech, which is the gold industry. Let me go into because I'm not going to just tell you, I'm going to show you. Let's go to my screen here. And let's click P Gold, because I was looking it up because I was trying to find something. It says Comtech Gold is CGO, that's its ticker, gold pegged crypto, in a sea change in the gold market, right? Well, you keep scrolling, it says zero making charges, trade at international gold prices. And then you continue, and it talks about the big well. Comtech CGO is a 100% gold-backed cryptocurrency that tokenizes physical gold, allowing users to invest in fractional amounts as low as 0.01 or about a penny. Globiance, right? Globiance and Comtech Dubai to offer gold and silver backed. So if Comtech, which is a gold company, is partnered with Globiance right now, and they have tokenized gold, right? That's one thing that I was looking up today. Comtech is going. I was looking up that too. So Globiance is going for. You see that 7? That means there's 7 zeros along with that 0 in front of that 1. It's gone down. No, I couldn't be like, well, that's not good. That's really bad. That means that, blah, 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 blah. Do you think I'm worried? Answer is no. Why? Okay, so the fully diluted market is $9 million. is $6 million self-reported and $143,000 inside of the market. Okay. So, why am I not worried? Because this company, gbex, or gbex is its ticker, that is gbex. Gbex has a verified check mark, one. You go into it, they only allow for you to, like, if you put money in, you're only allowed to take out 0.5% per day. Why is that such a big deal? I wouldn't know how to invest everything in there if it's better than some 401ks. When I invest everything in there, because that means you're only going to be able to take out 0.5%. So if you make $1,000, 0.5%, it's almost like it forces you to still keep money inside of the market. The reason why they want you to continue to keep money inside the market is because if you're, how do I say this?